Hi everyone, and welcome back for this new session in risk and compliance. This week we are discussing risk and compliance in relation to insurance compliance. Now we've seen banking compliance last week, which was an introduction to the kind of legal issues that banks face, the reasons why we regulate banks more than other companies, the way we regulate banks, what do we mean by banking compliance. Now, this week is going to be fairly similar in terms of its structure. We are looking at insurance compliance. Banks and insurance share a lot of traits. They share a lot of similarities in terms of their interaction with the financial system, with the fact that they have a large number of customers, including individuals, families, and that part of what they do has an impact on people's finances, including family savings and personal savings, but also the role they play for companies, small businesses, large businesses. Because of that, banks and insurances face similar issues and a very high level of scrutiny on the part of government, on the part of regulators. Because of that, both of them are highly regulated. However, banks are not insurance companies aren't banks. Their business is very different. We will speak about that today and the difference between the two businesses, the two sectors. This week, what I really wanted to do is, as we did last week with banking, give you an overview, explain to you, and let you discover by yourself some of the reasons why we regulate insurance. What do we mean by insurance regulation? Who are the people who enforce these rules? And then finally, look at insurance as a potential career, look at insurance as a potential first job, get a step in the door, get a foot in the door in the financial services sector. Insurance companies are one of the largest employers in Hong Kong, including employees of graduates. They offer a lot of jobs. We're going to speak about the kind of profile they are looking for, the kind of things you can do to increase your chances of going into insurance if this is something you want to do. We've got the program on slide 2. What do insurance companies do? This is our first part. How do we regulate insurance companies? This is our second part. And then the market for insurance in Hong Kong. We will close with the third and last part. Move with me to slide number 3. What do insurance companies do? Now, you may think that insurance are a relatively safe, and you may even say boring business, and you will be forgiven for thinking so. Right. Insurance companies aren't necessarily the first thing that comes to your mind when you think of financial risk. If anything, you go to an insurance company to become safer, to make your business safer, to make your life safer. You buy an insurance policy, you sign an insurance contract and pay an insurance premium, and in a certain way you are safer. But you are safer, if you think about it, because an insurance company is taking this risk, right? You become safer because the risk has moved from you onto another company. And so when an insurance company attracts a lot of risk, when it is paradoxically very successful in getting lots of clients, it also attracts a very high amount of risk. And because of that, the risk can be too much at a certain point. That is also one of the reasons why insurance regulation is kicking in, to bring in this risk and to make sure that we control this risk, that it doesn't spread to the rest of the financial sector. Now, slide number 3 is a highly simplified summary of what insurance companies do. But effectively, people, customers, small businesses, large businesses, individuals, people like you and me, the university or an institution, a car owner, or someone who owns a flower shop will contact an insurance company, but not directly, generally through a broker or an agent. Now, brokers and agents do almost the same job, but they are different in that an agent generally only works for one insurance company, whereas a broker often serves several insurance companies. So if you go see an agent and it's AXA's agent, or if you go see an agent and this agent is a Ping An agent, this person can only sell you insurance from Ping An or from AXA. Whereas if you see a broker, this broker might have relationships with 20, 30 different insurance companies, and they will be maybe able to find the one that's absolutely perfect for you, right? But they might not get the best condition from each insurer. They are not specialized in one type of insurer, but they might have a wider choice, right? So you contact a broker or an agent, and this broker or agent will be in touch with an insurer. And generally, as an individual or as a company, as a customer, if you want, when you're on the left side, you're the customer, you generally do not speak to the insurer directly. Generally, all your contacts will go through the broker or the agent. It's true to calculate your risks, establish a contract. It is true for making a claim or for renewing your annual contract with the company. Generally, the insurance company does not want to deal directly with customers. This is why brokers and agents exist. Insurance companies are specializing in highly technical calculations and creation of new products. They are doing this job internally, and they are very inward looking. They are very data driven. They are not customer centric businesses. This is really done by the brokers and the agents. Of course, this is changing. Some insurance companies now are more client facing and deal directly with clients. But as a matter of tradition and in the sense of how the industry is organized, many, many times customers still deal with brokers or agents. We therefore buy a policy, but why would you buy a policy, right? Why would you buy insurance? Well, maybe because there is a risk. There is a risk that maybe you have a car accident, and because of that, you like a car insurance. There is a risk that you get sick or that your children get sick, and because of that, you need to buy health insurance. Or maybe there is a risk that you lose your job, and therefore you need unemployment insurance. You may be facing the risk that you're not able to repay your loans anymore. You're buying a loan from a company, you're buying a house on credit, getting a loan from a company or from a bank. There is a risk that one day you don't have the money to repay, so maybe you want an insurance for that. You can buy insurance for pretty much anything. But why would you do that? Why would you spend money for something that maybe you're not sure is going to happen, and at the same time give this money to a company that is then going to take the risk? Well, it has to do with how we perceive risks. We generally tend to overestimate some risk and to underestimate some of them. But as individuals and sometimes as companies, organizations, what we value is certainty. A lot of things that we do in daily life and a lot of things that we do, a lot of the choices that we make in the professional world or in our personal lives is driven by a certain notion of risk. We will talk about risk a little bit later in the semester, but keep in mind that some risks are unacceptable. For people who have children, the risk of facing medical bills that are higher than even the annual salary is unacceptable. And because of that, they would rather buy health insurance. The risk that their car is completely totaled and does not work at all, and that they cannot purchase a new car because they don't have the finance for it, is unacceptable. Now, the real probability that a car accident happens might be extremely low, but this is not necessarily a factor when buying car insurance. The real question might be, what do you really do if tomorrow you have a car accident and you absolutely cannot use your car because the repair cost is too high? These customers, the people on the left of this chart on slide 3, go and buy insurance from a broker or an agent. The reason they do that is because the risk is not acceptable for them and they want to send the risk to someone else. Not to the broker, not to the agent. These people are not taking the risk. It's the insurer, or what we call the underwriter, who is taking the risk. So the person on the left is buying a car insurance so that the risk of a car accident moves to the right of the chart. And suddenly, the insurer, the underwriter, is now responsible if anything happens to the car. Historically, this happened when trade started to really pick up in the 14th and 15th century. In places like Italy and a little bit later in the Netherlands, in what is now the Netherlands or Belgium, a lot of families became extremely rich by trading. They were sending ships to Asia to buy, say, silk or materials that could be resold at a much higher price. For instance, some crops, some agricultural products that could not be found in Europe. And they were bringing these back into Europe and selling them and making a very large profit on these merchandises. But sometimes ships sink. Shipping might be a pretty safe activity nowadays, but accidents still happen. But back in the 14th century, back in the 15th century, over 500 years ago, 600 years ago, shipping was extremely dangerous. On some types of travel, for instance from Europe to America, 1 out of 3 ships would not make it. 1 out of 3 ships, which was going from Europe down to the west coast of Africa, then to America, then to come back in Europe, would not survive the voyage and would not come back. What does that mean? If a company owns 200 ships, it can survive losing 1, 2, or 3. It has the financial power to do so. But at that time, companies were not that big. They were not as big as General Electric or Li Ka-shing's Empire or Samsung. The companies were much smaller. They were family owned. The financial system was almost non-existent. They could not borrow money to increase. They could not borrow money to simply launch new businesses. Companies were much smaller. These were family businesses. They often had one ship. And if that ship sank somewhere between Asia and Europe with an entire cargo of tobacco or an entire cargo of silk or spices on it, the entire family would lose everything they had. They would go to ruin. They would not be able to repay their debts. They would suddenly lose absolutely everything they had. And because of that, trade was a game of luck. Trade was a game of luck, and the people who were becoming extremely rich were not necessarily the people who were better at trading. They didn't have necessarily the best products, the best sources, the best customers, the best processes. Instead, they were simply very lucky not to have lost any ship. What did people do to counteract that? They got together and they decided to share the risk. Originally, not by putting the money together and saying, well, if the ship sinks, then we will all put a few dollars on the table and repay that person so that we can all continue to do business. It is what happened in the end, and that's how insurance companies were created. But originally, the way it was created is that they were sharing the cargo. So 3 families were bringing back merchandises, cargo from Asia. One of them had spice, another one had other agricultural products, and the last one had maybe gems and diamonds and other things that you use to make jewelry. They would exchange the cargo so that on each ship you had a little bit of silk, a little bit of tobacco, a little bit of other agricultural products, a little bit of diamonds. And then they would just exchange it back whenever they would come back to Italy or come back to the Netherlands. They would share the cargo. They would share the risk by actually moving boxes and bags from a ship to another, so that if one ship sank, they only would lose 1/3 of their cargo instead of losing absolutely everything they owned. And they could survive. They could survive losing 1/3 of their cargo. They could survive losing 1/3 of their money. But they could not survive losing absolutely everything they have. Their business would go bankrupt. Now, starting from there, insurance companies developed. Some people specialized in organizing this. They became the insurers. And then some people specialized in selling this as a service, packaging it, and go and find other traders, other families, other people who put things on ships, merchandises and trade, finding these people and explaining to them that there are people who can share the risk with you, and they can put you in touch with them. These are the brokers and the agents. So this entire world developed because of risk, because of high risk in trade. Now, if you move to slide number 4, you will see that you can buy insurance for pretty much anything. And that is one of the interesting things that happened recently, particularly in the world of insurance. It is that you can buy insurance and cover for pretty much any type of risks. There are very few things you cannot insure. But you can buy, as a business, general liability insurance, property insurance for your premises if something happens, if the house burns down. You can buy commercial car insurance for your fleet of cars, of trucks. DNO is a very interesting thing. As you become professionals, you will come across something called DNO insurance, which is directors and officers insurance, which is an insurance policy which covers directors and officers of the company for liability for wrongdoing and alleged wrongdoing. So, for instance, they will pay for your lawyer when you go to court, they will pay for your investigation fees if you are under investigation, up to the point where you manage to prove that you are innocent. And that way, the company doesn't have to pay millions of dollars to its directors, and insurance companies can actually do it. You have workers' compensation insurance that is for when your employees get sick or have an accident at work, and you have to compensate them. Then you don't lose money if you have workers' compensation insurance. Professional liability insurance. All the lawyers have professional liability insurance. You have to, by law, provide liability insurance, meaning if you are wrong, if you do something wrong, if you get something wrong, if you make a mistake in analyzing the law, if you make a mistake in advising your client as a bank, as a lawyer, as a barrister, as a consultant, then the insurance company will compensate your client for your loss, which allows you to continue to do business. Data breach, this is very recent, but it is happening right now. Insurers now provide insurance for hacking. So if your company gets hacked, if all your data, all the customers' information of the personal information of your customers, if the personal data of your customer, if the credit card numbers of your business suddenly gets stolen, you can be reimbursed for that. You can actually get compensated for that, but you need to buy an insurance policy for that. Key person's death, this is quite interesting. When someone is so important to a business that this business would probably not continue without this person, you can have insurance so that the business gets compensated, generally a lot of money, in the event of this person disappearing, in the event of this person dying. That's happening, for instance, in small businesses, family businesses. One person, the CEO, the founder, the person who is still in charge of the company, is so important to the business that there is a special type of insurance to protect the business against the fact that this person may not always be alive. You have insurance for product liability, so that's for manufacturers. You are manufacturing construction materials, cars, food. What if something goes wrong and someone gets sick or gets injured? Because of your product, you can be insured for that. Business interruption insurance, for any reason your business stops. In that case, you can be compensated for all the business that you would normally have made on a normal day. If, for instance, for 2 days, 3 days, 4 days, because there is no electricity, because a conflict breaks out, because of any type of reason you can imagine that a business would stop functioning, you can get compensated for that. Now, it's not all about business, and some individuals can also buy insurance. You maybe have health insurance, car insurance, home, life insurance, disability, critical illness. That's when you get very sick, you can get compensated for a certain type of illness. Now, I want to attract your attention right now to something very important in these two lists, and it's life insurance. Life insurance is something that you buy in the event that you will die. Now, we all know that we don't live forever, and one day we will be very old, or hopefully not, something happens, and we're not here anymore. Because of that event, your family will get compensated. So if you buy life insurance, and tomorrow you have an accident and you die, then your family, your immediate family, your parents, your brother, your sister, will get a large sum of money in the event that you die. Why do people do that? Because we're not around forever. Not every retirement saving plan is effective in really providing for money and saving enough money so that you can give it to the next generation. And because of that, a lot of people buy life insurance. Now, life insurance is not like a car insurance. It's very different. It will happen At one point, the insurance company will have to pay this sum of money to the beneficiaries of the insurance, of the policy. We know that will happen because no one lives forever. And a lot of people they pay every month $1,000, $2,000, $300, $500, any kind of sum. You can decide how much you put. And the day you die, all of this money, plus maybe some interest, will go to someone else. If you think about it, it's different from other types of insurance. Rather than a simple type of insurance, what this does is that it's a savings plan. What this does is that the person who buys this insurance is effectively paying money every month for a very, very long time. And they know for sure that they will get the money back. It's not like health insurance, maybe you won't get sick, you won't use it. It's not like car insurance, where you don't know if you're going to have a car accident. It's not like D&O insurance, you don't know if there will be some accusations of wrongdoing at your company. Life insurance is different because it will happen. We don't live forever. Because of that, someone will get the money. What does that mean? Think about what we did last week with banking compliance. We talked about how banks are regulated because if they go down, if they go bankrupt, if they close their doors, what happens is people lose money. You, I, our friends, our family, some people have life insurance, and if the insurance company goes down, goes bankrupt, runs out of money, runs out of business, then this money will be potentially lost. And that is a fundamental problem in the financial system. That is a risk that is considered unacceptable by many governments. And because of that, insurance companies are highly regulated. We are now narrowing down the issues and the reasons why insurance companies are so regulated. It is because they are trusted with people's life savings in the form of something called life insurance, which is effectively a savings plan. For that reason, insurance companies face higher scrutiny, higher responsibilities than other types of companies. Another reason why these companies are regulated is because of complex financial products that they have developed and that they have sold. Complex financial products which during the financial crisis in 2008 went terribly wrong. Slide number 5, this is what is called the Lloyd's coffee shop. It was in London. This place doesn't exist anymore. You can visit the building where it used to be, but it is not a coffee shop anymore. It is where all the insurers, all the shippers, all the people who used to need insurance would get together and find each other. Slide number 5, as you can see, it's a very old representation of something that happened a long time ago. Slide number 6 is what Lloyd's looks like nowadays. The Lloyd's of London, one of the biggest marketplaces in the world for insurers, is an incredible place, a standalone skyscraper in the middle of the city of London, where insurers, brokers, and agents meet each other. This has become a highly sophisticated, very modern type of business. And because of that, because of the size of this business and the size of the sophistication of what they do, they have developed very complex products. Slide number 7 reminds you of why we have insurance companies. Because ships can still sink. Financial markets can go wrong and people can stop paying their debts. Car manufacturers need a lot of money, a lot of metal, and a lot of manpower and energy so that they can make money. The shops can suffer from environmental consequences such as floods. We know here in Hong Kong, typhoons happen, and companies can be very, very sensitive to adverse weather. And so we need insurance because of that. Because of that, of course, insurance has a profound impact and a very important role in trade and in every single human activity that involves money and risk, which is to say any kind of business activity. Trading, putting containers on the ship, going from city to city, port to port to sell merchandise can still be very risky. Financial markets can go wrong. Car manufacturers and other heavy manufacturers need so much capital that the slightest risk in their supply chain can disrupt their entire business model and put thousands of jobs at risk. But in reality, what we see in slide number 7 is the relatively traditional approach to life insurance. Insurers find risks and they insure against that risk. What they have started to do in recent decades and in recent years is to build very complex financial products, which are complex because they are mathematically complex and not everyone understands exactly how they work. And they have sold these products to banks and to other types of companies. One of the products they have developed is the credit default swaps that went terribly wrong during the financial crisis. Credit default swaps, document number 2, a short Investopedia page, and even a video on credit default swaps, explain what are these products. A credit default swap is a type of swap. A swap is a traditional type of contract whereby two people agree to effectively take a risk, but in exchange for this risk, they have a little bit of certainty as to today. And when it's applied to a credit default swap, what it means is that if one person, company A, borrows a lot of money from another company, company B, which is probably going to be a bank, the bank is taking a lot of risk and doesn't really know if someone's going to repay this loan, maybe in 2 years, 3 years, 10 years. And so what the bank is very tempted to do is to take a little bit of the profit from that loan and give it to an insurance company to say, if company A doesn't pay me back, you pay me back. Now, the insurance companies, because they are masters of risk and they are really focused on calculating, putting numbers on risks, really believed that they could calculate the risk of default on complex loans. So they started selling financial products to banks, whereby the banks would discharge the risk of the bank's customer not repaying the loans onto insurance companies, and the insurance companies would charge a lot of money for that and they would make a lot of profit. And it all went very well until 2008. And we talked about the global financial crisis, the GFC, last week. What happened in 2008 is that a lot of people stopped paying their loans. They stopped paying back. The result of that is that a lot of people, a lot of banks, a lot of lenders turned to insurance companies and said, here is the list of people who did not pay me back. I have a contract with you saying that you are therefore going to pay me back for all these loans that defaulted because of my CDS, my credit default swap that I signed with you. The insurance companies started paying back a lot of money. And what happened is that one of the biggest insurance companies in the world, could not repay all of its obligation. AIG, one of the biggest companies in the world, one of the biggest insurance companies in the world, essentially ran out of money in 2008. The enormous surprise came when the US government took control of AIG, effectively had to lend billions of dollars, 85 billion US dollars, to AIG, but in exchange took control of the company, took control of the equity, the shares of the company, changed the management, put its own management in place, and tried to start cleaning the books. How did they want to do that? If you have read document 3, you know, document 4, you know that the way they tried to do that was by selling assets that the insurance owned. The insurance had lots of branches, lots of smaller specialist insurance companies that potentially were worth billions of dollars, and they were hoping to sell these on the market, that other insurance companies would buy them, that investors would buy these subsidiaries. But because of the global financial crisis, no one could buy these subsidiaries, everyone was running out of money. People had to keep their money to strengthen their balance sheet and try and look like they were in good health, so that investors would not leave them, would not abandon them, and no one bought assets from AIG. So the US government had to continue to inject money into AIG. That was done to save the financial system. That is one of the things that the US government did, together with providing cash to the banks. Providing cash to the insurance companies was absolutely essential at the time to the survival of the financial system. Because of everything we've explained before, the importance of insurance and how a lot of banks had moved their risk from themselves back to the insurance company, we needed these insurance companies to stay there and to continue to repay the contracts they had promised they would pay if something goes wrong happens. The credit default swaps gives us the last reason why the banks are as regulated as insurance companies, why insurance companies are so regulated. As I put it on slide 8, 2 reasons. The first one is that they have people's savings through life insurance. The second is that they have so much complex financial products that there is a risk that an insurer does not have at one point enough liabilities, enough assets to meet its liabilities. The third reason is consumer protection. It's kind of a bonus reason to regulate insurance companies. It's certainly not the case in Hong Kong that consumer protection is so strong that it adds special requirements on insurers, but effectively an insurance company is a financial service company. It is very sophisticated. It can sell products to people who do not understand this product. Therefore, there are special obligations in terms of being transparent, creating products that make sense, providing information when selling these services, when selling these contracts, these policies, and making sure that the people, the individuals who buy these products understand what is happening. Slide number 9, I want to put it here. This happened in September 2008, and I can assure you that when this headline came, the world suddenly changed. The world of financial services suddenly changed. A few weeks before this day of 16th of September 2008, no one could have predicted that one day the US government would become the owner, the controller of one of the largest companies in the world, one of the largest insurer companies in the world. It was absolutely unthinkable, even a few weeks before that the US government would suddenly provide so much money to an insurance company and in exchange would take control of that company. That goes against a lot of things that were believed to be true at the time. The fact that the US government believed in free markets and that they would believe in free enterprise, and that if people make mistakes and crash, then let them crash, the market will fix it. It's a private mistake. It has nothing to do with government. It's not the government's job to support the economy. The market supports the economy, and the government creates the condition for it. Against all of that, in September 2008, the US government injected so much cash in AIG that they became the owners of AIG. I want to move to how do we regulate insurance companies? Insurance companies are specific businesses. The way they do business is a bit different. The way they move their money around is a bit different. The way they calculate risk is a bit different, because that's essentially how they make money. But the way we regulate them is effectively quite similar to the way we regulate other businesses. First of all, it's licensing. Licensing for insurers, for brokers, and for agents. We've done it last week with banking. You know what licensing means. Licensing means not everyone can be an insurer. And once you are an insurer, there are things you can do and cannot do. And if you do it wrong, then the government can take this license away from you or punish you in many other ways, including fines. Being able to discipline those who breach the rules is an essential part of licensing. On slide 11, we see that a little bit more in detail. There is a clear separation of banking and insurer. This is document number 3 for you. You have a short explanation on Investopedia on the differences between banks and insurance, and the fact that an insurance company should not be a bank, they should not take deposits. The fact that a bank should not insure risk, this is not their job. Banks and insurance are separated companies. So when you are an insurance company, you can't do banking. When you have a license, when you have a license saying you are an insurance company, you cannot do banking. They have different models, they have different roles in the economy, the risk they face is different. They simply are not the same type of business, and doing both bank and insurance at the same time would probably be too risky. We are also looking at regulating the type of insurance that businesses can sell. Document number 6, the insurance audience, shows you that the things that an insurance company can do is relatively limited. There are a certain number of insurance products, there are a certain number of things and risks that an insurance company can insure, and anything else cannot be insured. There are a certain number of contracts that can be sold, and anything else cannot be done by an insurance company. So that's what we said previously 2 minutes ago on licensing. Licensing means regulating what you can and cannot do once you have a license. There is a very interesting reform taking place at the moment as we speak in Hong Kong. I invite you to really take an interest in what's happening in Hong Kong and the creation of the IA, the Insurance Authority. The IA is a new regulator that did not exist 2 years ago. It has been created to replace partly the not really regulating authority, which was the Commissioner for the Office of the Commissioner for Insurance, the OCI, which has now lost its powers. All of these powers have been given to the Insurance Authority. And there are also bodies which are private, which do not belong to governments. 2 bodies now currently regulate who is a broker, who can be a broker. Gradually, the Insurance Authority will take over these powers. The Insurance Authority is a government body. It is independent. It's not a part of government. It's not obeying to Carrie Lam's order and the administration of Hong Kong, but it is a public body. It's not private. What's very interesting is that at the moment they are taking over licensing. They already took over what we call conduct regulation, which, as I said, means to punish an insurance company or a broker when they did something wrong. And they also took over MPF, which is, of course, our savings system for effectively old age, right? So, of course, everyone will get old one day. And so because of that, every month of your life when you get paid in Hong Kong, a little bit of money will be taken, called MPF, that will be put into an account, and that account will be available to you when you retire. This is your retirement scheme, which is similar to life insurance, and also one of the reasons why we regulate insurance companies. We can't allow them to go bankrupt. They actually have people's savings. They have your savings, my savings, right? The reform in Hong Kong is not done. There are discussions about granting the losses that the Hong Kong government could maybe have a fund, taking a very, very small tax on insurance companies' profits or turnover. And if an insurance company goes down, to use that money to repay people who have lost their money, maybe up to 1 million Hong Kong dollars. This is currently being debated at LegCo. This is happening as we speak. I invite you to take an interest in these debates. This is part of insurance regulation. This is part of insurance compliance. Remember, we've seen it with banking, that one of the things the governments could do to regulate banking and to shore up the banking system and to create more trust was to say, if anything happens to the bank, I'm here for you, I will step in, I will repay the money, I'm the guarantor. That also happens in insurance, not yet in Hong Kong, but there are discussions right now about having a guarantee system in the Hong Kong insurance market. This is document number 5, an article by Enoch Yu at South China Morning Post on the recent discussions at LegCo about creating a fund specifically for this. Very interesting debate. Please take a moment to read these articles. They are very important. There's another article, document number 7, which is produced by a law firm called Insurance Regulation in Hong Kong. This is produced by a US-American law firm called Norton Rose Fulbright. Norton Rose is famous for its insurance practice. It is a very large law firm globally and very strong player in Hong Kong. and they have all these free resources which are very often useful. They are simply articles and posts which are online, newsletters about all sorts of legal issues, including on insurance regulation. So if you want to know tomorrow what's the insurance regulation in Vietnam or in Hong Kong or in China, you go on Norton Rose website and Google will probably send you there to kind of give you an overview in 5 minutes of what's the regime in Hong Kong. If you need to understand what is the insurance regulation in Hong Kong, you look at article number 7. This is one of our readings for today. We move on together to slide number 13. What is happening with insurance regulation in China? We have said it before. We talked about insurance in China during our first week, and we said that insurance in China was not highly developed. It is not as developed as, say, in Hong Kong or in New York or in London, in more international financial centers. And the offering, the range of products and services available in insurance in China is still relatively limited, but it is growing really fast. And because it is growing extremely fast, insurance companies are actually becoming richer and richer. Because of that, they actually also face that dilemma where for a long time the Chinese government has encouraged very large companies to go abroad, to buy a lot of companies, to buy a lot of assets, and to effectively become giant conglomerates. But when you are an insurance company, you should be careful about doing business which has nothing to do with insurance. You don't want your insurance business to suffer from your other investments. You don't want your other investments to suffer when you should be focused on making sure that as an insurer, you are the safe business that people need, that the financial sector or the financial systems need. Because of that, there is a recent reaction on the part of the Chinese government. It happened a few months ago, last year, effectively 12 months ago, when the Chinese government started telling insurance companies you can't buy anything that is not insurance-related business anymore. And what we see now is a crackdown, literally a crackdown on some alleged activities by large insurance companies. Often these companies are public. They are not state-owned enterprises. And because they are private businesses, because they aren't necessarily that related to the government, what we see is also the Chinese government regaining control over some part of the financial system which escaped them, but also some part of the financial system which is not so far so regulated and which might create a risk, an enormous risk for the financial system. One article for today is article number 8 on how the Chinese government is planning to reform the regulation of insurance and to actually have a single regulator for banks and for insurers. This is happening right now as we speak. Have a look at article number 8, a short article by The Guardian. This is an interesting one. All right, I will discuss this with you more in detail in class, but I just wanted to spend a couple of minutes at the end of this session right now so that we have time to discuss the insurance market in Hong Kong. Slide number 14, what you see is on one hand, insurance companies, insurers, and on the other hand, these are brokers. You may not know some of these names, but I'm sure you know some of them. Of course, the insurance companies are more famous, right? AIA, AIG, China Life, AXA, Chubb, some of them are large household names in Hong Kong. Some of them are very large multinationals, some of them are large Chinese companies. We all know these names. Look at them, look at their website, look at their recruitment policies. What are they looking for? What is their traineeship program? What is their internship program for the summer? This is something you want to look at. You don't want to look at that at the last minute when you're looking for a job. You want to look at that months in advance and kind of have an idea of whether you'd be interested or not in applying there. What you probably know a little bit less is the brokers. And the brokers and the agents can be lots of different companies. You probably know Aeon. Aeon is the Japanese supermarket retail chain, but they also offer credit cards. Because they offer credit cards, they also offer insurance services, and because of that, they are an agent, an insurance agent. Ctrip, you probably know Ctrip, very famous website for booking travel. Every single large travel agency now offers insurance. Why? Because people sometimes buy insurance when they travel. Because of that, they are agents. Because of that, they need people for compliance. They need people to deal with regulatory obligations, reporting obligation, license management, and day-to-day dealing with the regulators. So think about these companies if you're interested in insurance. Some of them are maybe less famous, and we will talk about them in a little bit more detail, but please make sure that you are familiar with the insurance market in Hong Kong. Slide number 15, these are what we call graduate trainee program or trainee management programs. The first one is from Manulife, the second one is from Zurich. These are just two quick examples of what's happening in the financial sector, in the insurance sector in terms of recruitment. You do want to think about this because you need to apply early in advance. It will be too late if you wait until graduation. You do want to look at these as potential paths for your career. These are high-paying jobs, solid jobs, large companies, excellent training, excellent program. Really, really a good place to start your career. If this is something you're interested in, have a go, have a look at their website, take 5 minutes to understand whether this is something maybe you want to do. We've said it when we started this course, it is also about professional qualifications. There is one professional qualification for insurers in Hong Kong, the IIQE, the Insurance Intermediary Qualification Examination. It means for people like brokers, agents, for anyone involved in the insurance business, you need to take this examination. Sometimes some professionals, some companies will send you there, they will make you take the test, but it will give you an enormous edge, an enormous advantage in terms of recruitment if you already have it. Because of that, you should have a look at the IIQE. If you're interested in insurance, it's an exam for insurance professionals that everyone needs to take in Hong Kong when working in the insurance sector. It is held several times per year, both in Chinese and in English. The pass mark is quite high, it's 70%, but it's multiple choice question, and you have to contact VTC if you want more information about that. Before we go, I wanted to make you think of insurance as a slightly moving business, changing business. And this is actually our last document for today. Document number 9 is about how the insurance sector needs to change. And what I put in document 17 also has to do, in slide 17, sorry, has to do with how the insurance business is changing. Look at this ad, you've probably seen it in the MTR. It was all over the place in Causeway Bay a few months ago. Manulife was launching something called Move. What is Move? It's a program whereby if you download the app from Manulife on your Apple Watch and you let Manulife track how much sports you do, how much activity you do, you will pay less for your health insurance. Why? Well, because basically when you're buying health insurance, the company that sells you insurance doesn't really know if you're in good health or not. They can make you fill forms and answer questions, but they don't really know whether you're in good health or not. With your Apple Watch or with any other kind of tracker, any kind of Fitbit or any other device that allows you to record your progress as you do some sports and fitness, with that, the insurance company can know exactly how healthy you are. If you are healthier, you are less likely to get sick. If you do sports, you are less likely to require critical illness insurance, disability insurance in the future. Because of that, you should pay less, right? The risk has a price. If the risk is lower, the price is lower. That is a very interesting that's happening right now. But the article, document number 9, also talks about a number of things happening in the insurance sector, about disruption and change, and how the insurance companies are changing. Some of them are not changing, but some of them are embracing technology. There is an entire sector today called InsurTech, which is insurance technology. How can we, with things like the Apple Watch or other devices, or big data or data mining or artificial intelligence, better calculate the risks to maybe reduce the middleman, reduce the agents, remove the need for a broker, or maybe simply get a better price, a better rate, so that, for instance, the good car drivers don't pay for the bad car drivers. It's something the insurance companies have been trying to do for a long time. Technology is changing that, so the entire sector is evolving and is more dynamic than maybe what you had in mind when we talk about insurance. On this, I hope that you find this interesting. We will speak about all of that tomorrow, but for that you have to come ready and prepared, so please do the readings, take the time, and come so that we can discuss the things all together. Thank you very much, and see you in class.